You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Unilever, Airtel Africa, Nestle, Whitbread, Segro, and our American company for the week is Tesla. And there's going to be a book review at the end on the permanent portfolio. So Sam, shall we start with Unilever?
Yes.
For a bit of background, for anyone who doesn't know, it's the largest consumer goods company listed on the FTSE 100, and they have their third quarter results out this week, with revenue for the quarter coming in at 13.5 billion euros and underlying sales growth of 2.5%. That was largely driven by price increases as volumes fell in all of their categories. Full year sales growth is expected to be between the 3 and 5% target range and comes in at 4.4% for the first 9 months. In beauty and personal care, that division had revenue up 2.6% to 5.7 billion euros. However, the volumes were down 1.3%, with growth in Vaseline and prestige beauty offset by falls in the skin cleansing and oral care. Prices rose 3.9% with higher commodity prices. The home care division saw sales up 1.4% to 2.7 billion euros, with price rises of 4.8% and volume declines of 3.2%. The normalization of home and cleaning products after an exceptional 2020 contributed to this. Food and refreshment saw sales growth of 3% to 5.1 billion euros, whilst volumes were down 0.8%, with ice cream demand falling back with the poor weather and travel restrictions in Europe. Prices rose 3.8%. All of the geographies followed a similar trend, but the Americas was the strongest performing region with underlying sales growth 4.4%. Asia and the Middle East, Eastern Europe stood at 2.3%, while Europe was largely flat. Interestingly, the e-commerce division grew 38% and now accounts for 12% of total sales. Also of note was the completion of the separation of the tea business on the 1st of October, which saw a net positive impact of 1.6% on sales from acquisitions and disposals. Unilever announced a quarterly dividend of 35.98p per share, along with the ongoing share buyback programme. In terms of valuation, Unilever has a market cap of just over £100 billion and trades at just over 17 times earnings, compared with a 10-year average of 19. Currently yields about 3.9%, and it's the second largest company on the FTSE 100. It's a company that I still like. I think it's a long-term quality play, and it still maintains margins of around 19%. And an interesting statistic with Unilever is that 2.5 billion people worldwide use a Unilever product every day. And although it's stagnated, the brands are still very durable, and I think they probably will be, even given the ongoing price rises with inflation. But I think the stagnation that we're seeing with it is probably priced in at 17 and a half times earnings for a business of this quality. What do you think of it, Sam?
I like it. I think these are good results. I think you know what to expect. You know you're going to get the 3 to 5% revenue growth. It's not going to blow you out of the water. I think 4.4% for the first 9 months is pretty good. It's at the higher end of what you'd expect, probably. And like I say, I think these results are probably what you'd expect. The only concern I would have had is the inflation. And I think they have been able to pass it on to customers. And that's what I would have wanted them to do. If they hadn't tried to pass it on, I probably would have criticized them and said, well, why haven't they done that? Like, if you're not going to pass it on now, when is there going to be a better time?
Yeah.
So I think the fact that they have been able to pass it on, and the products are so cheap, it doesn't make a huge difference. Yes, it's going to be a little more expensive than like the supermarket's own brands, but people pay for those brands. That's why they're more expensive. I think these are good results. I like it. I think 17 times earnings is very reasonable given the quality of the business. And I think the dividend yield is very secure. And given how high it is, you wouldn't necessarily expect it to be such a quality business with a yield of almost 4%. I think you could do a lot worse than Unilever. 12% of total sales from e-commerce for a business like Unilever is actually quite high, I think.
Yeah, and it's an interesting trend. We'll come on to it when we discuss Nestle, but more of the consumer goods businesses seem to be going down down that route. Okay, so let's move on to Airtel Africa, FTSE 250 company, Sam.
It is. So Airtel Africa, we've covered it a few times before. If you want a sort of a fairly brief overview of what the company does, you may as well go back to last week's episode with the sloth investor, because it did end up coming up in that. So I'm just going to assume everyone knows what it is. So Airtel Africa have come out with their results for the half year ended 30 September 2021. And they've reported revenue growth of 25.2% to 2.272 billion, with double-digit growth across all regions. And in the second quarter, the reported revenue growth was 20.3%. The revenue in constant currency grew by 27.6%. There was strong double-digit constant currency revenue growth across all regions. Nigeria was up 32.4%, East Africa was up 25.8%, and Francophone Africa was up 22.1%. And across all key services, with voice up 19.7%, data up 36.9%, and mobile money up 42%. Underlying EBITDA grew by 35.2% to 1.098 billion in reported currency, and underlying EBITDA margin improved to 48.3%, an increase of 360 basis points, led by both revenue growth and improved operational efficiencies. Underlying operating profit was up 55.1% to 732 million in reported currency. Profit after tax more than doubled to 335 million, largely due to higher profit before tax, which more than offset the associated increase in tax charges. Basic earnings per share was 7.6 cents, which was an increase of 155.9% as a result of higher profit. EPS before exceptional items increased to 7.5 cents from 3 cents in the previous period. So before the exceptional items, it was 7.5 cents, and without it was 7.6 cents. So they didn't really make much difference. Operating free cash flow was 853 million, which was up 43.1%. I should have said it at the start, all these figures are in dollars. The leverage ratio, which is the amount of debt compared to, I think it's adjusted EBITDA is what they use from memory, but that ratio has fallen from 2.2x to 1.5x, which is more than manageable now. I think it's probably at the point where I'd say it's not really concerning for me, at least. Whereas when they first listed, I think it was over 9x, which is extraordinarily high. The customer base grew by 5.4% to 122.7 million, with increased penetration across mobile data, where the customer base was up 10.9%, and mobile money services, where the customer base was up 19%. Customer base growth was affected by the new NIN/SIM registration regulations in Nigeria, and excluding Nigeria, the customer base grew 13.7%. The board has declared an interim dividend of 2 cents per share, and they aim to grow the dividend annually by mid to high single digits from a new base of 5 cents per share for the 2022 year. And that's probably about a 4 or 5% yield. That would be. The current share price is about 110p, which is a very high yield for such a high growth company.
So do you want to discuss some of the reasons that you think?
Yeah.
What's the valuation of it?
So there's one thing from Segun Ogunsanya, the new CEO, he did a statement. In the statement, it's probably worth saying. He said, as incoming group CEO, I've inherited the responsibility to build up on a business with solid foundations. And as I look ahead, I continue to see huge potential across voice, data, and mobile money from low penetration levels across Africa. Continent continues to be a growth story for us despite the pandemic. We'll continue to invest in mobile and digital technologies to drive digital and financial inclusion sustainably in Africa. I'm pleased with the progress we've made in the last couple of years. And he did say as well that the risks from COVID still remain, with sub-Saharan Africa continuing to experience a third wave of the pandemic. And vaccinations remain low, but I guess fortunately it's not really the kind of business that's been too badly affected. But yeah, in terms of the valuation, these results now put it at a PE of about 12 and a market cap of 4.11 billion. And the historic dividend yield is about 2.6%, but with the new dividend policy, it's probably going to be more like 4%. In terms of why it's so low, I think the debt was an issue. I don't think it's as much of an issue now. I guess the business is probably going to be quite capital intensive. However, if you look at the cash flow is very good at present. There's obviously regulatory concerns. It operates in countries, where it's difficult to predict what's going to happen in them. And they had it where they had to sell 25% of one of their subsidiaries in local markets, just because government brought in regulations saying you had to do that. The tax rates are quite high. I think they average like 30 to 40% in the African countries they operate, which is very high compared to like the 19% we've got over here. And I guess the fact it's telecoms, I think it's like not that glamorous. I think the main reason it is so cheap is because not many people cover it. I mean, if I think back to when we first covered it on the show, if it hadn't been a quiet week, I never would have picked it because it said it was a telecoms company. So I thought it was just going to be like a boring business, basically. So,
and it's got the to me anyway, the mobile payments business.
Yeah. I mean, even if you take the mobile payments out, it's still insanely cheap. But mobile payments, they're planning to spin that off as a separate business within a few years and list that separately. I mean, you don't know what the valuation will do between now and then, but I'd be perfectly happy potentially holding both businesses after that. But Airtel Money, I think, is very exciting as well. That's valued at about 2.5 billion on its own, and they don't own 100% of it. I think it's like 75% of it they own, but that's still like just under 2 billion, and that means the rest of the business is, and they don't make up a huge amount of the profits yet still either. So that means the rest of the business is almost worth like 2.5 billion or 2 billion. It's just unbelievably cheap. I continue to not see anything else like it. So it's my second biggest position now. It's 15% of my portfolio. I backed up the truck on it.
Okay. No, I mean, I think they're incredible results. Definitely risks associated with the business and the regions that it operates in. But I think one of the statistics I read about the country or the African nations that it does operate in, you've got internet access at only about 20%, and that's obviously growing rapidly, and Airtel is benefiting from that. So I think structurally it's got everything going for it, and the mobile payments I think is one of the gems in the business where you're getting phenomenal growth and profits. MasterCard, I think, have taken a 10% or a 9% stake in it, and I've taken a position relatively recently, but I wouldn't be averse to buying more shares of Airtel. I think it's an exciting business, and I think probably undervalued, and the risks, yes, there are some, but well worth it at this price.
Yeah, I actually wouldn't be against buying more either. The only issue I have is not letting it get too big, but it's just so cheap. I just sort of think I sort of want to own as many shares as I can because it's just so insanely cheap. I think the risk reward is just way off with it.
It's way off, yeah. I would agree with you there. Okay, so on to, possibly less exciting company, Nestle. So another is actually the world's largest consumer goods company, going on from the world's second largest, which was Unilever, also having their third quarter results out. Sales for the first 9 months grew 7.6% to 63 billion Swiss francs, growing across nearly all of their geographies, and the recovery particularly in out-of-home channels. Prices rose 1.6%. In the Americas, sales were up 8.4% to 24.6 billion francs, with price rises of 3.2%, and again, recovery in the out-of-home sales. In North America, sales grew across nearly all of the categories, but home baking fell, unsurprisingly, after an exceptional 2020 with the COVID pandemic and lockdowns. In the Middle East, Europe and North Africa, sales were up 7.2% to 15.5 billion francs, with strong growth in Russia, Turkey, the UK and Italy. Purina, the pet care brand, also grew double digits, as did coffee sales, but there was a fall in pizza sales and infant nutrition. So again, that's really reflecting those trends of the pandemic, with dog craze going on, more puppies being bought, and people not having as many children, birth rate being lower. Asia and Africa saw sales rise 4.1% in the first 9 months, coming in at 15.2 billion francs. And the Nespresso brand grew strongly, with revenue up 11% to 4.7 billion francs. And the health sciences division grew 14.3% to 3.2 billion francs. E-commerce sales grew 17.2% and now account for 14.1% of total sales. So similar picture to Unilever there. Nestle now expects the full year sales growth to come in at between 6 and 7%, with underlying operating profit margins of around 17.5%, so just under Unilever's. In terms of valuation, market cap is around £260 billion or 329 billion francs. and it trades at 24 times earnings compared with a 10-year average of 20, and it currently yields around 2.5%. So very, very decent results there, better than Unilever's, and it's got, well, comparable brands, I would say, the same, if not higher quality than Unilever's. It's also worth mentioning that it's got a 23% stake in L'Oreal. That's particularly high margin, and I think it's probably priced accordingly. It's more expensive than Unilever, but their results and the growth are that much ahead of them. So I don't know whether I'd be taking a position in them at the moment, but I think it's a quality business and probably a fair valuation for what it is. What are your thoughts on those numbers, Sam?
I actually think it's too expensive.
Do you? Okay.
I just think, I know they are better results than Unilever's, I accept that, but they're not going to grow at 7.6% a year. That's just not going to happen for a business of that size. I think I just think at a P of 24, I'd rather have Unilever at 17.
At 17.
Definitely.
Yeah.
It's just quite pricey, I think, especially, and it is above the 10-year average. And I appreciate the growth's a little bit higher, but I think it's quite reasonable to assume it's probably not going to be sustained.
What do you think of the stake in L'Oreal? Because I suppose that's something that is quite valuable. And I think it's one of those things with the personal care, it's higher margins than, I know Unilever's got rid of it, but your Floras and some of your more sort of,
yeah, but I mean, Unilever's got some very high margin brands as well. And I do sort of think, like, I don't know, does it justify a PE multiple that much higher? Like, if we were talking like 17 for Unilever and 19 for Nestle or 20 for Nestle, if it was at the 10-year average, it's a different conversation if it was at 20. But I think at 24, for me, it's
a bit too much.
It's a bit too much, yeah. It's just hard to get a good return on that, I think.
Okay.
When you're paying that much.
Fair enough. I mean, I have Unilever, Kraft Heinz, and Reckitt. I don't have Nestle, but yeah, I think if it came to it, it's a business I like, but you'd be paying up.
Yeah, I mean, it is a quality business, and if you were to like use the bond proxy argument, I mean, you're getting a P of 24. I can sort of see the argument. I just think I'd rather pay for Unilever. If you say to me it's going to grow at 7% a year for the next 10 years, I think I would pay 24 times earnings for it, but I don't think it's going to.
Yeah. Whitbread. That doesn't have the same valuation.
Well, it doesn't have earnings, does it?
Okay.
Right. So Whitbread have reported their half-year results, and they've reported revenues in the half of 661.1 million, which was 39% below pre-pandemic levels, but well ahead of the 250 million reported last year. The decline reflects the fact that only essential business guests were permitted until May 17th, and other restrictions were not fully lifted until 19th July. Accommodation sales grew 12.3%, ahead of the wider mid-scale and economy market during the half. The group reported an underlying loss of 56.6 million, an improvement on the 367.4 million pound loss reported last year, but well below the 235.6 million profit reported pre-pandemic. The losses reflect lower revenue versus the relatively fixed nature of the cost base. Whitbread's lenders continue to forbid the payment of dividends, while certain conditions have been relaxed. As things stand, that will continue until at least March 2023. So if we break those down a bit more, the UK part of the business reported revenue of 650.6 million, 39.4% behind pre-pandemic levels. That's despite opening 20 new hotels compared to pre-pandemic, with 830 hotels and 80,810 rooms. Occupancy in the half was 61% compared to 78.3% pre-pandemic, with an average room rate of £52.63, down 17.9%. The region delivered an underlying loss of 17.8 million, despite government support and reduced operating costs. In Germany, the group reported sales of 11 million, so that compares to 650 million for the UK, up from 3.7 million pre-pandemic. That reflects new hotel openings, which have gone from 3 to 30 over the period. Occupancy fell from 60.2% pre-pandemic to 32%, with average room rates of £36.49 compared to £64.15. The region reported an operating loss of 7.3 million. Whitbread is committed to opening 9,814 new rooms in the UK and 8,578 in Germany. Free cash flow in the half came in at 139.2 million, a significant improvement on the 426.8 million outflow last year. The group finished the half with net cash of 60.2 million, excluding lease liabilities of 3.3 billion. That compares to 196 million a year ago, excluding 3 billion of lease liabilities. Management believe UK revenue per available room could fully recover by some point this year and are confident that UK profit margins will eventually return to pre-pandemic levels. The group has slightly increased its estimate for new UK rooms during the year to 3,500. In terms of valuation, there's no earnings. So price to book is 1.66, and that compares to a 10-year average of 1.78. It's currently trading at £32.66 a share, and that compares to a 52-week high of £37 and a 52-week low of £20. It's currently down 9.7% from where it was 2 years ago and 12.42% from 3 years ago. It's up 7.79% in 5 years. My view is this is a business, well, I'm surprised it's so close to pre-pandemic levels when the results are so far away.
Yeah, because what was the figure pre-pandemic profit?
Pre-pandemic, so pre-pandemic it's 235 million profit for the half, so 2 years ago. It's currently at a loss of 56 million, which is better than the 360 million loss the previous year, but it's still some way off. And things are fully open now, and they're not back to, the occupancy rate's still not back up, and who knows when it will be, because as well, like, how much of Premier Inn's business travel and how much of that is going to fully bounce back, because Zoom meetings aren't going away.
And I'm not sure at what point Costa was sold, but it must have been about 2 years ago as well. And I think it was a much more attractive business when it had Costa and that Costa brand. I mean, they did get about 6 billion for it, I think, but it wouldn't be one I'd be looking at.
No,
it wasn't before, but I like the Costa brand.
Yeah, I'm the same. I would have found it more attractive with Costa in it. I think the diversification probably could have done them a bit of good in the last couple of years. And I think that, I don't think it was the best business in the world pre-pandemic, but it's definitely a much worse business now. And like, if you think it can get back to pre-pandemic levels, like how much, I mean, say it goes back to like £40 a share, which it was briefly over a couple of years ago. It's already at £32 a share now. So what's that, like 20-30% return? I mean, it's a lot of, seems like a lot of risk for a fairly low return, really. And it does have quite a lot of debt as well. The fact they're not allowed to pay dividends is not a good sign. So I just, there's no price at which I would touch it. I think it's just better to leave these kinds of businesses alone.
Yeah, no, I would agree with you there. Okay, fine. So on to one of our companies in the fancy portfolio, Segro. So it's the largest FTSE 100 real estate investment trust, formerly known as Slough Estates. It specialises in warehouses.
It's had a good year, hasn't it?
It has. It's had a crack.
It'll be up like 30% in the portfolio.
Yeah, it is. It is. Something's good.
I'm pleased with that. At least I'm sure there's a few, but I've not looked at that probably since it went in the portfolio. So I didn't realize it was doing so well.
Okay,
so that's the kind of buy and hold strategy that we're trying to.
Well, it's just don't look at things, and it does. They do well.
Yeah.
When you start, the more you look at them, the more irrational you are. Okay, so it's
let that be a lesson to all our listeners.
Sam, this is not going in. This is
not that bit, but this little this sort of snippet about the share price and the McEwen quote there. What was it? The less you look, the less rational. The more you look, the less rational you are.
That's it.
You could get that on a mug. That's like people would attribute that to Ben Graham.
But it is true. I mean, I've probably just learned that from all of these books, because that's essentially what they say. And the more you have them on, I think it was, which book was it? The Education of a Value Investor, I think. He says that, and he's like, I only allow myself to check the share price like once a month or something, or like once every so often. And that he hates Bloomberg machines because, you're just constantly constantly looking at them and wanting to do something. But anyway, get back to it. Segro, the largest FTSE 100 listed retail investment trust, formerly known as Slough Estates, that specialises in warehouses, had their third quarter results out this week. The group announced strong rent roll growth with £26 million of new headline rent signed during the quarter, taking the total for the year, for the first 9 months of the year to £64 million, which is up 28% compared with last year. Vacancy rate fell further to 3.2%, with strong demand for recently completed development space. And customer retention stands at about 76% for 2021, after the group took the opportunity to take back some space in the urban estates in London and Paris. And the group also noted that their development programme continues to deliver high quality growth and returns, with the potential to increase annualised rent roll by 20% or £92 million from the pipeline of space under construction and in advanced discussions. In 2021, there have been 450,000 square metres of new developments, which are capable of delivering a further £25 million of headline rent, with 93% of this already let. And there are developments due for completion in the fourth quarter, which account for a further £31 million of rent, £26 million of which has already been secured. A further 998,000 square metres is under construction, with a potential future headline rent of £68 million and expected to generate a yield on the total development cost of around 6.8%. Additional pre-let projects in advanced discussions equate to approximately 196,000 square metres of space, with potential capex of £211 million and associated rent of £24 million expected to commence in the coming months. Segro has also acquired over £260 million of land in 2021 so far to top up their land bank and provide further growth opportunities, with £66 million of land acquired in the third quarter, including the sites in Italy, Poland, and 2 further plots in London acquired in early October. Meanwhile, £98 million worth of urban warehouses in Italy and a standalone big box warehouse in Spain were sold, as was an asset swap which resulted in the acquisition of a significant urban warehouse in West London for £140 million and the disposal of a standalone UK big box site and urban warehouse for £205 million. The group remains on course to invest over £750 million in the development pipeline, excluding land acquisitions, during 2021. Net debts currently stand at £3.3 billion, which is up from the £3.1 billion in June, and the group has issued a Segro green bond for €500 million with a coupon of 0.5%, so pretty low. In terms of valuation, Segro has a market cap of £15.5 billion and trades at 31% premium to net asset value and currently yields approximately 1.75%. It's a business that I like. It's certainly not as cheap as it was at the start of the year when we added it to the fantasy portfolio, but I think it's still very high quality and it's on the back of a growth trend, but more of a defensive play on that. Sam, what are your thoughts on these results?
They seem pretty good. 19% improvement in pre-tax profit. You can't really complain about. I'm surprised it's trading at such a premium to the net asset value per share. Yeah, so the net asset value per share was only 909p at the end of 30th June, and it's trading significantly, it's about 30% above that. Yeah, I don't want to say anything negative because it's in the fantasy portfolio, but it does look. I appreciate it's on the back of a good year, but I think it looks a lot more reasonable when you put it in the fantasy portfolio than it possibly does now.
Yeah, I'm pleased with how it's done, but you're really paying up for it now.
Yeah, I mean, I can't imagine it's going to continue. If it stays in the portfolio for the next year, I can't imagine it's going to continue to compound at 30% a year.
No,
it'd be fantastic if it did.
Right. It would be, and I mean, it is on a growth trend.
But they are good results. It's obviously it's not. I think property's not been the worst sector to be in the past 12 months, has it?
No, quite. Okay, so on to our American company for the week, and this does make Segro look cheap, but they had some good results out this week. Tesla.
Yes, Tesla. So for anyone who's not aware of them, they are the car company, or well, I guess the energy company, as some people like to say instead. So they've come out with their Q3 results, and they reported revenue of $13.8 billion. All these figures will be in dollars, which is a 57% increase year on year and modestly ahead of market expectations. Growth was driven by a 58% increase in automobile revenues to $12.1 billion. And overall vehicle deliveries rose 73% to 241,391. Operating profits came in at $2 billion, a 148% year-over-year increase, but slightly less than the market hoped. That was despite setting aside $190 million for likely share-based payment to Elon Musk. The man's worth $120 billion. What's he getting? What's his net worth?
Let's have a look. Yeah.
That's the man's worth $292 billion, and he's paying himself $190 million to run his own company. It's like, Oh, I'm not being funny, but like that's 10% of the profits. There's just no need for that. It's just, I mean, that's a rounding error for him. It's just that's not impressive for me.
No, fair enough.
Anyway, so the revenue per vehicle is down, and that's as a result of a change in the product mix from the higher price Model S and X's to the lower price Model 3s and Ys, as well as a 30% decline in automotive credits. The improved operating margins reflected operating leverage achieved with increased production as well as cost reduction. Headwinds in the quarter included lower average sales prices, lower regulatory credit revenue, and a $51 million Bitcoin-related impairment. These impairments are a bit silly, because I think when they put Bitcoin on the balance sheet, they impair it, but they won't be able to revalue it back up afterwards if it goes back up. So it's a bit of a non-issue, really. You can just ignore it. But capital expenditure in the quarter was $1.8 billion, up 81% year over year, as the group continues to invest in new factories in Berlin and Texas, as well as ramping up production in Shanghai. Free cash in the quarter came in at $1.3 billion versus $1.4 billion a year ago. Tesla finished the half with net cash of $7.9 billion, up from $846 million. The group continues to face challenges with semiconductor shortages, congestion at ports, and rolling blackouts that are preventing factories running at full capacity. They made 500,000 cars in 2020, and that compares to 5.3 million for Volkswagen. And of Volkswagen's 5.3 million, 212,000 were electric. So Volkswagen's 40% of the figure Tesla does as electric cars, which is actually slightly surprising. So in terms of the valuation, the company trades at a PE ratio of 122.4, and that compares to a 10-year average of 73.1. There's no dividend. And one thing that is interesting, I was looking at the Ford results the other day. Ford had absolutely cracking results as well. I think I guess you can't sell cars quick enough at the minute, can you?
Well, it's a chip shortage.
Yeah, so you can't, but Ford's results were cracking as well. Ford would need to 16x to get to Tesla's valuation. Tesla's market cap is, I'll just double check it, but I think it's about $1 trillion. It's 1.03 trillion with a T. It's John. So your thoughts on these results and Tesla's valuation?
I mean, they're good results, but I just can't get my head around the valuation. I think that is something, and like you say, Volkswagen and all of the other car manufacturers are making electric cars. I'm no expert in terms of the technology, but you would have thought that is going to eventually catch up with Tesla, and everything is priced in Tesla's direction at the moment. But I wouldn't be buying shares. I don't know. What are your thoughts on it going forward?
I think the valuation is crazy, but I've thought that since it was about 50 billion, to be honest. Any exits there? It's 100. So it's now a 120 bagger for Flosser.
Gosh,
it's mad, isn't it?
And he won't have sold anymore.
No, he's still got it.
He made his mistake when he sold the first.
Shout out to Flosser. He's got bigger balls than me. But yeah, I just think like 1 trillion valuation. I mean, that's like, I think Toyota's only about 200 billion, and that's the biggest car company in the world. I just think, like, I appreciate people saying it's going to do energy.
What do you mean by biggest car company in the world in terms of sales?
Sales, yeah. I think any measure you want to use, apart from market cap.
Yeah, Toyota. Exactly. Yeah.
But I just think, like, even if it's like, say it is an energy company, it's going to do all this, how much money is it going to make? Because if you look at, just one sec. So I'm just thinking of like, what's the most insanely profitable company you can think of? It's probably Alphabet. So currently, Alphabet is, let's have a looky, at a $2 trillion valuation and trades at a PE of 28. And that is with, so what will the earnings be for that? I'm not going to spend ages looking for it because it's like, it's not that relevant. But the operating profit was 72 billion. I mean, if how much is Tesla going to make? Could it be in a position where it's making $50 billion of profit a year, which is an unbelievably insane amount when you think about it? And the best companies in the world, there's a handful that do it. And these are just monster companies. Let's say Tesla can make profits of 50 billion a year one day with its cars and its energy and whatever else it's going to do. That's a PE of 20 on the current price. That's still pretty pricey. I don't know if it's going to carry on growing still, but I recorded an interview earlier today with a guy called the 20s Trader, who's a good follow on Twitter, by the way. And he was very good. We actually talked about Tesla, and it's just like, I mean, what I was saying to him, you'll hear it in a few weeks, but like, to invest now at a $1 trillion valuation, if you assume the market's going to go up 10% a year for the next 10 years, how much does Tesla have to, like, how well does that business have to perform to outperform the market? Because say it's going to be at a P of 20, that means it needs to get to $50 billion of profits a year. And then on top of that, it needs to grow that by more than the 10% the market's going to grow at. So you end up with a final figure that's just so insanely high. I don't know why anyone in their right mind would invest in it at a $1 trillion valuation, because there's just so much of that future growth is priced in.
Yeah.
But the results, it's kind of like a Cardo on steroids, I think. Where like it is a good business and it is performing well, but the valuation is just ridiculous.
Yeah.
So, of the 6 companies we've talked about this week, Nestle, Unilever, Segro, Whitbread, Airtel Africa, and Tesla. If you had to pick one, which one would it be?
Definitely a few I like, but Airtel will be my pick.
Not Tesla.
Not Tesla, no. I mean, the Airtel's valuation and the growth prospects there, and on the most recent results, is delivering on it.
Yeah, Airtel for me. I don't know if any company would actually get picked ahead of Airtel for me at the moment.
At the moment, yeah.
My second choice would probably be Unilever.
Yeah, I guess, yeah, it would be Unilever, but Unilever and Nestle probably a third, then Segro, and then it would be a toss-up between Whitbread and Tesla, actually.
I think I'd probably go with Whitbread before Tesla, just because I feel like you've got more downside. I know I'm picking a company that might go bust, but I just feel like valuation-wise, you've probably got more downside protection.
Yeah, and I mean, Whitbread has been around for, well, I think it's hundreds of years now, and it's owned just about everything on the high street over its time. It seems to manage to survive, but anyway, we'll see what happens with that, or with both of them. Okay, Sam, what have you read this week?
I have read The Permanent Portfolio, which is about Harry Browne's long-term investment strategy, which I think you've already read it, haven't you, John?
Actually, I haven't, but
all right. I assumed you had because you got it for me.
I know.
Fair enough. It's basically,
I think it was on my list to read, basically.
So you've used me as a guinea pig.
Yeah,
it was quite good. So it's basically the idea of the permanent portfolio is you have 25% stocks, 25% bonds, 25% cash, 25% gold. You rebalance, I think it's annually, and then you also rebalance if something gets above 35% or below 15% or something like that. It's quite interesting. It looks at how it's done since like the 80s. It talks about and it mainly talks about that. It's quite interesting to see how it's done. It did outperform the market in that time period. I don't know, and I guess I appreciate it's a portfolio for like all market conditions over the long term. I don't know how comfortable I'd be having a portfolio that's 50% cash and bonds in the current environment. I can't imagine it's done too well in the last few years. Although I guess if you're doing it over decades, you'd say, well, that's to be expected. You can have periods where different assets perform differently. It's quite interesting to see the results, but it's not something I'd ever seriously consider, to be honest. And as well, I think once it basically explained the way the portfolio works and how the rebalancing is done and the results it would have gotten over the different time periods, a lot of it's quite basic stuff. Like a lot of it's like there's a chapter on gold where it talks about like how you buy gold and like why it's good as an investment. And a lot of that stuff, obviously, like lots of other books have already covered it. So for me, like the idea was interesting and it was quite an interesting read, but there were large parts of this book that I basically skimmed because I wasn't really getting a huge amount from, but
yeah,
it was still all right.
Well, out of interest, with the proportion that was in shares, does he talk about, is it index funds, is it individual stocks?
He said index funds. So he said if you want, but he does say like, because there's a chapter on like changes you can make to the portfolio. And he said like, if you wanted to have like, say like 10% of the portfolio in individual stocks and 15% in index funds, and that's your 25%, that would be fine. Or if you had like a separate portfolio that you played with for like your individual stocks. But yeah, it's mainly index funds. Because I think the idea is you can read this book and then it's like, go away and do this. And you're going to get like a 10% return a year on average. And it was interesting as well, because it did actually, as well as slightly outperforming the market, it did have much more downside protection. So in the bad years where like, you know, the S&P is down 30%, this thing might be down like 5%. So that is the benefit of like the cash and the bonds and stuff, but it just wasn't really for me, probably.
So you'd sleep better at night, or some would sleep.
I think you would, but I don't know how comfortably I'd be sleeping at night with a portfolio that's 50% cash and bonds at the minute. I would be losing sleep over that.
Yeah, no, fair enough. And I suppose that is, you know, since 2008, that's been been the case.
So. And I know like it's probably always like this, but I don't see anything that's going to change that. I think because the governments just can't afford for the interest rates to go up, because then they can't pay the debt. So they've got themselves into a bit of a muddle that I think it was possibly quite difficult to anticipate when that portfolio was being created. Yeah.
It's different to how it is now, but it's interesting to see how that will continue to perform, and also perhaps how it's performed in the last decade.
Yeah, I've not actually looked. So the book was written in like 2012, so it just stops there. It reminds me of I think it's Templeton that said it, where he said that like the four most dangerous words in investing, and this time it's different, but this time it might be different. So
but I mean, you'd have presumably a larger allocation to equities.
I'd probably, especially given my age. I think if I was like in my 50s, it's a different conversation. And if I did want to hedge it, I'd probably hedge it with Bitcoin. That's what I'd do.
Okay.
I wouldn't be against having some gold. I just don't know if I wouldn't go 25%.
Yeah. No, I mean, I've certainly, in the last year, I have been buying commodities and gold being one of them, but gold separately. And that it's actually, paid off well, and it more as a hedge against inflation. But still got relatively low bond exposure, but continuing to index in the world index. So,
any other commodities you've been buying in the last 12 months?
Bitcoin, if you call it a commodity, has been that, and it's very, very small stake, but just indexing in, and that's, as we know, Bitcoin has been doing very well over that period too. But no, it's the digital gold argument that we've talked about lots of times before. That is the reason for it.
Very nice, and it's in the fancy portfolio as well, so that'll be doing quite well as well.
It is.
It's hard because you've only looked. There's only we've not actually looked at everything in it and how it's done on a year-to-year basis, but I think the fancy portfolio might have had a fairly good year. I do wonder how the American side's done though, because the valuations were very frothy then. And we tried to cover it at the time, but it's difficult. We did buy some expensive businesses.
They were, and the world index, which was our benchmark, has been performing strongly as well. So,
I guess people something to look forward to. It's not clear either way.
The world index, just for reference, not that we've got the fantasy portfolio performance to hand, but it must be up 15%.
Oh, that is a tough benchmark.
It's we'll see. We'll see.
I suspect America might have dragged it down.
Okay, we've got Segro in there, which is...
We had Berkshire Hathaway. That's done well. That's up like 40% in a year.
Yeah.
Berkshire Hathaway might have been a double.
Yeah, and we've got a few stocks that we had a decent yield on them, so we'll have to see how...
Yeah, I can't actually remember everything that's in there now. I'll have to look at the list.
Yeah. Okay. Fine. Okay. Well, that's something to look forward to, which is, winter special, New Year special.
Yeah, it was around then when no one was reporting earnings.
Yeah, exactly. So I think on that note, we'll leave it there. Thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.